Before you even sip your morning coffee, a trillion-dollar machine quietly whirs to life, a system so massive it dwarfs the GDP of most countries, and yet, it could collapse in just 1 hour. Your bank account isn't sitting safe in a vault, it's part of a high-stakes game where banks lend, borrow, and trade billions every single day just to stay afloat. This is the repo market, the hidden heart of global finance, where debt is swapped for cash, collateral is king, and a single misstep can ripple through the economy. In 2019, this invisible engine nearly seized, and the Fed had to pour in billions to prevent chaos. Today, central banks aren't just regulators, they're addicted lifelines, propping up a system that can't survive without them. The question isn't if this game continues, it's what happens the morning it stops. Every morning, before you wake up, before the markets open, and while the coffee is still brewing in the break rooms of Wall Street, something invisible happens. It is a transaction so large it dwarfs the GDP of most countries. It happens in silence. It requires no physical movement of money. And yet, if this process were to stop for even 60 minutes, the global economy would essentially catch fire. You have heard of the Federal. You have heard of central banks. But you have likely never seen the machine that actually keeps them alive. This isn't just about interest rates or inflation targets. It is a daily, trillion-dollar balancing act that keeps the entire financial system from collapsing under its own weight. Today, we are going to look at the plumbing of the world. And what we find might make you wish you hadn't looked at the pipes at all. To understand this, you have to forget everything you know about how your personal bank account works. When you deposit money, you think the bank keeps it in a vault. They don't. They lend it out. They invest it. They move it around to make more money. By the end of the day, a commercial bank, think of the big ones, JP Morgan, Chase, Bank of America, is never actually square. They have thousands of payments going out to other banks and thousands of payments coming in. But here is the catch. Regulations require these banks to hold a certain amount of cash in reserve at the central bank. If they end their day with less than that requirement, they are in trouble. If they have too much, they are losing out on potential profit. So, every morning, they play a game of musical chairs. This is the repo market. It is the beating heart of finance. Imagine Bank A needs $1 billion for 24 hours to balance its books. It goes to Bank B, which has a surplus of cash. But Bank B isn't just going to hand over $1 billion based on a pinky promise. They want collateral. Bank A hands over high-quality assets, usually government bonds. Bank B gives them the cash. They agree on a price, a tiny sliver of interest, and the next morning, they reverse the trade. Bank A gets its bonds back, Bank B gets its cash plus the interest. It sounds boring. It sounds like routine accounting. But this market is where the ghost of the 2008 crisis lives. Because when the banks stop trusting the collateral, or when they decide they would rather hoard their cash than lend it, the machine grinds to a halt. This is why this matters to you. In September 2019, this trillion-dollar machine had a stroke. Suddenly, there wasn't enough cash to go around. Interest rates in this shadow market spiked from 2% to 10% in a single day. The Fed had to step in. They had to inject billions of dollars into the repo market to keep the lights on. They didn't do it because they wanted to. They did it because if they hadn't, the banks would have stopped lending to each other, which means they would have stopped lending to businesses, which means payrolls would have been missed, and the reality you live in would have hit a brick wall. The irony? We call this a free market. But it is a market that requires a central bank to act as the lender of last resort every single morning, just to keep the status quo functioning. We are now in an era where the scale of these operations has shifted from necessary maintenance to a permanent state of emergency. We have moved into a world of quantitative easing and reverse repos, where the Fed isn't just an umpire, they are the biggest player on the field. They are essentially managing a global liquidity addiction. When the market gets the jitters, the central bank provides the fix. When the collateral starts to look risky, the central bank buys it to keep the price stable. We are told this creates stability. But what it actually creates is a system that can no longer survive without intervention. Think about the math. If you spend your life preventing small failures, you don't end up with a system that has no failures. You end up with a system that is structurally unable to handle a large one. So here we are. We have a financial system that is effectively held together by a daily, high-stakes trade of debt for cash. It is brilliant. It is efficient. It is entirely fragile. And the question that nobody in the boardrooms wants to ask is this: what happens when the central banks run out of moves? We have spent decades building a house of cards, convinced that as long as we keep the cards moving, the house will stand. But every morning, the game resets. Every morning, the debt is rolled over. The system relies on our belief that the math will hold. But belief isn't an economic indicator. And eventually, the math catches up with everyone. The question isn't whether the game can continue. It is what happens on the morning that it doesn't.